This is the World Financial Report on radio with Harold Siegel. My name is Randy Marshall. Joining us by the telephone, our financial and diamond expert, Harold Siegel. We're taping the show on December 27th, a Friday, 2013. Our final show for 2013. I'm very excited about the prospects for 2014. Our radio show runs on your favorite radio stations. It's also archived on Harold's websites, HESradio.com, rarecoloreddiamonds.com. We have a podcast through iTunes. Type in World Financial Reports on Radio. You'll find the podcast there. It's portable. We go anywhere your portable device does. On top of it, Harold does daily market commentary. Find it on his websites and the podcast site as well. In February of 2014, I will have been doing this show with Harold 12 years. Harold started doing the show right after 9/11, so he's around 13 years. The show obviously continuing into 2014. We're very, very excited about it. This will be the first year in 12 years. 12 years in a row, we had gold positive. This will be the first year that gold is down. Diamonds, outstanding year. We'll talk about it later in the show, but as we go into 2014, with them peeling back the quantitative easing, economic and geopolitical concerns continue to be something we need to watch. 2014 could be a very dicey year. Harold, it was an outstanding year for rarecoloreddiamonds.com. Not only hsfineauctions.com had all those great auctions, but you were on Bloomberg Television, Bloomberg Radio. You, beyond doing this show, were interviewed on a lot of little radio stations all over North America. It was just an outstanding year for you personally in rarecoloreddiamonds.com and your auction site, hsfineauctions.com. And I know that sometimes in these markets, the way they have been manipulated due to quantitative easing and other forces, it's hard to predict. But we know at the end of the day, when you have a diamond in your hand, when you have gold and silver in your hand, they cannot print that. And we're seeing massive money printing continuing around the world. And at some point, it will have an effect, Harold.
I 100% believe that. Again, this was a tough year. There's no doubt about it. And at the beginning of the year, we always do our prediction show, and this year will be the same. You know, we are excited about what's going to happen in 2014, but, you know, it's going to be a difficult year. There's a lot of uncertainty in the markets. Nothing has really changed all that much from 2013, except if you read the headlines. You know, just reading the headlines today, getting ready and prepared to do the radio show, you know, it's difficult at times to sometimes fathom and understand, you know, how you could have two such opposite sides of the fence. You have Wall Street, where you've got the Dow at record prices, and the people on Wall Street, the brokerage firms and the brokers and a lot of the investors are euphoric at this point. They think this is the greatest thing, and they're ecstatic. And, you know, they stuck it out since 2008 and 2009 when the markets plummeted. And in most cases, it made back the money, and in a lot of cases, people have profits. You know, but when you really look at the Dow Jones, the stock market type of thing, you've got the S&P 500 at record prices, but you have absolutely no growth. So that's the concern to me. And realistically, if you were to propose that to an expert and say, is it possible for a stock market to hit record prices, but then on the other hand to have absolutely no growth, they would say, no, that's an impossibility. But that is what happened this year. And the fact is that the markets have been manipulated. Now, I certainly understand that. You know, the fact is that the economy, the financial system as we know it, was almost destroyed in 2008 and 2009. You know, we had the money market funds plummeting. We had people lined up to take their money out of the banks. There was countless numbers of banks that went bankrupt. We had government intervention. The government jumped in and saved AIG, the biggest insurance company in all of North America. They jumped in to save General Motors and Chrysler and Citibank and Bank of America and all the major brokerage firms. And everybody that was in trouble, the U.S. government stepped in and saved. Now, in hindsight, they had to do it. They took a gigantic risk, and they steadied the ship. The fact is that in 2008 and 2009, if they didn't do what they did, we probably wouldn't be sitting here talking the way that we are right now. We would be in a totally different financial situation. So they did do what they had to do. I've got to give President Obama those accolades because, again, he reacted and he did something that was positive. However, by putting the $20 trillion or so that they put back into the market, and when I say $20 trillion, they bailed out all these companies, but they also did quantitative easing. What that means is the Federal Reserve and the U.S. government kept putting money back into the market, into mortgage-backed securities, and back into the bond markets, and back into the stock market to stabilize the stock market and to get prices higher. And again, I'm not against that. I'm not against the stock market. The fact is that what it has done is it brought a lot of money back into play. A lot of people have regained a large part of their wealth due to the fact that the market came back up. What I have a problem with is the fact that the market is not hitting its records based on fundamentals. It's based on, again, this quantitative easing. And that's a scary situation. What it basically means is that as long as the government and the Federal Reserve continues to put close to $1 trillion a year back into these mortgage-backed securities, the bond market, and the stock market, it'll keep the market stable and moving higher. But there has to be a point within the foreseeable near future where this all ends. You cannot just continue to support the market by printing all this money that the Federal Reserve and the government is printing. Now, the scary thing is that by this particular point, since 2008 and 2009, and probably $20 trillion or more, nobody knows the exact number, but after all this money has been put back into play, got the stock market into record territory, houses are starting to pick up a little bit of a value. The economy seems, it's a lot better than it was in 2008, but again, you're looking at a situation that just doesn't feel right. It's not doing it based on its own merit, and that's what the frightening thing is. And when they stop putting in this money, does it mean that what we saw back a few months ago when they talked about stopping quantitative easing and starting to taper, the market sold off heavily? It sold off 600 points in 2 days. So the fact is that either they continue to taper until the economy strengthens itself, or they stop tapering and the market is going to plummet. And if the market plummets, or if they decide to start raising interest rates, what they're eventually going to do, because the U.S. dollar is absolutely plummeting. By the way, the U.S. dollar is one of the weakest currencies in the world right now. Even the lowly euro is at 139. That means it's 40% higher than the U.S. dollar. So the fact is that they can't stop quantitative easing. If they do, the markets are going to fall, and they're not going to go for that. So does that mean they have to continue to keep this quantitative easing going forever? And it also means that the markets that we're trading, if you are trading the stock market, you're trading a market that is a bubble, basically. It's not moving based on its own merit. It's basically moving because of $1 trillion a year being put back into the market to support it. And what they had hoped for, and this is one of the frightening things, what the government hoped for and was really banking on was that by putting this $1 trillion a year back into the market, it was going to get the market back on track. Businesses would start to do business better. They'd start to hire more people. People obviously would get back to work. The unemployment numbers would get down to 5 or 6%, and everything would be rosy back in the United States. And if that had happened, that would have been an amazing feat. But it's not happening. Unemployment, the numbers that they give us of 7% or 6.8% are not the true numbers. We know the true numbers are 15%. So the fact is that everything that they thought was going to happen, that the economy was going to come back strong, that companies would start to hire again, people would get back to work, making higher wages, paying more taxes, spending more money in restaurants and local businesses, and that's how the economy gets back on track, not by raising the stock market. So basically, nothing, in my opinion, has really changed this year. And we're going to go into 2014 in a very, very difficult time. Again, we're going to be trading in markets that are basically not trading on their own merit. They're trading based on what the government needs it to do. And that's why we talk about this type of desperation. So, again, I'm still working on this, but the beginning of the new year, we will do our prediction show. And for the first time last year, we were wrong. I've been in this business 35 years, and my business is to know these markets and make predictions, and I've been very, very successful at it. This was the first year that we were dead wrong, and again, it doesn't sit well with me because, again, nothing really changed in the marketplace. So we're going to discuss that next week on the next week's show as we enter into 2014. But again, I am expecting that these markets are going to be much more volatile, and we'll definitely make our predictions going into the new year. Right now, this week is the slowest trading week of the year. There's hardly any traders around. But one thing that has happened is that oil prices are back over $100 for the first time in several months, and we do believe oil prices are going to go substantially higher than where they are right now. Gold's back over $1,200, silver's getting back over $20, and again, we'll make our predictions next week. But that's the way I'm seeing things, Randy. Again, I don't see any major improvements. I see a lot of danger, and the biggest danger will come when they raise interest rates and these derivatives markets do what they did in 2008 and absolutely devastate the financial markets.
Well, I know this morning I was reading Business Insider, and they had a story about a young person who graduated university, had a law degree, and this person cannot find a job. So how great is the economy when you have somebody who has gone to university, racked up a lot of debt, they are a trained professional in their field, and they cannot find a job. This is why we're saying hard assets are a core in every portfolio, good or bad times. And one thing we've learned on this radio show, do not believe everything they say and don't believe what the mainstream is following, because you need to be a contrarian and you need to really take a hard look at the facts they're giving you and find out the truth behind them. That's why we put out our free weekly newsletter. The stories we send to you are ones that are critical for maintaining your wealth and growing it in the future. Profit and protect. Connect with Worldwide Precious Metals. That is the company that Harold recommends you use when it comes to investing in gold, silver, platinum, palladium. The telephone number to speak with them, 1-866-623-2002. The website, wwpmc.com. They had an outstanding seminar, and it was here in Edmonton and in Toronto. They're going to be coming back to Edmonton, Toronto, and Calgary. It was about the Canadian banking system and the world banking system. I did get a chance to see it. There was a massive snowstorm in Edmonton. I went out. It took me an hour and a half to get there. I'm glad I went because it was an amazing night. For those that are listening in Calgary, Edmonton, and Toronto, if you did not get a chance to go in 2014, they will be doing this seminar again. It is an eye-opener. Speak with Worldwide Precious Metals about reserving your seat for 2014. Absolutely free. 1-866-623-2002. And let them educate you as to why you should have gold, silver, platinum, palladium in your portfolio, and get your name on the list for our free weekly newsletter. In our newsletter this week, there was one comment that Richard Russell made that I thought was probably the comment of the year. That's why as we do our final show for 2013, I want to mention it again. Richard Russell said a few thoughts about gold. Never buy gold for a profit. Gold is a measure of wealth. Count your gold holdings in the number of ounces, not the current worth in dollars. You don't price the home you live in every day or with each passing week, nor should you price your gold holdings in dollars with each passing day. Gold is a timeless wealth asset, an asset that will have a value with the passing of time. Remember this, of the original issues made up of the Dow Industrial Average, only one remains. That stock is General Electric. And what happened to all the rest? In investing, nothing is permanent except gold. But remember, do not buy gold with the idea of making a profit. Buy gold because it is pure wealth and may be the last man standing. And we obviously have made a lot of money since 2002 when we started doing the show together. Harold and I, gold was around $2.50, silver around $4, and obviously we've made tremendous amounts of money, gold going up to over $1,900, silver close to $50. We believe that we could see those numbers in the future again. And really what you want to do is maintain your wealth. And one of the things that we have in our newsletter this week is a chart from Dennis Miller. And he says, how much does it take to keep up? To answer that question, consider the fictional Joe Smith. Joe got his first real job in January 1994, so he will soon finish 20 years on the job. He started with a salary of $50,000. Today, Joe is in his 40s, raising a family. Despite receiving promotions and salary increases along the way, he finds himself living from paycheck to paycheck. It's natural to assume that it's mostly due to the cost of raising a family. However, according to, and this is in the United States, the Bureau of Labor Statistics inflation calculator, Joe has to earn $78,997.64 today to maintain the buying power he had with his very first paycheck. And this is the challenge of all investors, having assets that cannot be debased, as we're seeing with money and quantitative easing. $75 billion a month they're spending and buying U.S. bonds. In fact, they own 1/3 of the entire U.S. bond market, the U.S. Fed. That's what we want to do, stay ahead of inflation. The other issue that I think is absolutely critical going forward is the financial bubble that the United States has due to all the promises they've made. Greg Hunter, who used to be with CNN, interviewed Professor Lawrence Klotnikoff, and he said, America is in the worst financial shape that it's ever been, even worse than Detroit, which went bankrupt. Boston University economics professor Klotnikoff says the country is in the worst fiscal shape by many miles compared to Detroit. So the country is essentially bankrupt. And he estimates that the long-term debt and liabilities of the United States are more than $200 trillion. He is spearheading a bill in Congress called the Information Act. It is attempting to wake up the nation in the United States to their dire financial situation so something can be done to fix this enormous problem. The bill has been endorsed by 1,000 economists, including 15 Nobel Prize winners in economics. Never in the history of their country, the United States, have they ever had this many top economists from all political persuasions endorse a piece of legislation like this. Dr. Klotnikoff and his fellow economists are very, very concerned. The country needs to do honest accounting. The professor charges the government is disguising the true problem. The government is printing mountains of money to pay its bills. The Fed is printing 29 cents of every dollar that Uncle Sam is spending. What happens if this continues? Eventually, somebody recognizes this and starts dumping the bonds, and interest rates go up, inflation takes off, and we're off to the races. In closing, he warns, this is going to crash, but there are different ways for cancer to kill you. It can be very gradual, or it can attack some organ and you can die overnight. Either of those outcomes can happen. And this is something, Harold, that we've spoken about on our show, and we have about 5 minutes in our segment here for quite some time, and that is the debt and deficit of the United States. And if you believe Dr. Klotnikoff and what he's saying, and we do, the United States has a serious, serious problem, and they need to deal with it, and they are not.
Well, I agree with him 100%. And again, I do believe it's only a matter of time. Now, on one hand, you've got the printing presses that can print unlimited amounts of money. And it all seems simple and good, except for the fact what that does to your dollar. Because it's like any other commodity, that when you're printing, for example, if there's way too much gasoline, way too much, everybody's overproducing, OPEC has no controls anymore, they're producing as much oil as they can in Iraq, Iran, and Saudi Arabia, and Russia, and everywhere in the world, and by doing so, the price has got to come down because the demand, there's no way in the world it can meet the supply. And that's the basics of the economic market. When demand is high and supplies are low, the prices always go up. And the opposite is also true. When the demand is very low and supplies are high, the prices will always go down. So the biggest fear is, and with the U.S. dollar, they're printing and printing and printing and printing so many U.S. dollars, and there's so many dollars in operation right now and in existence that it keeps on weakening the dollar even against extremely weak currencies. I mean, look at the euro. Things are not better in Europe, and the euro is a doomed currency, but it's 40% higher than the U.S. dollar. So as they continue to print and print and print and print more money and it weakens and weakens and weakens the U.S. dollar, eventually the U.S. dollar loses its buying power. And that's what's going to bring on massive inflation. So this is what's going to come. That is the reason, and probably the major reason, why we've been recommending gold and diamonds for so long, is because of that phenomenon that is going to happen. And it's inevitable. It's got to happen. It's only a matter of time. So as far as us, it's a matter of trying to time when that is going to happen. But there is no doubt it is going to happen, because how much more value can the U.S. dollar lose? It's already below the 80-cent level. It breaks 72.5 cents, and then it's going to free fall all the way down to the 50-cent level, and that alone could bring the price of gold up to $4,000 to $5,000.
You look at the United States, they have 11 million people on disability, more than all of Greece. There is going to be a coming pension meltdown. As the people in Detroit found out, your pension money that was promised is not safe. They could actually claw that back by 50% or more. In fact, to give you an idea, there are 10 cities in the United States with unfunded, a huge portion of their pension liabilities are unfunded. Charleston, West Virginia, liability $270 million. They only have 24% of it funded. Omaha, Nebraska, $1.43 billion. Only 43% is actually funded. And then you have other places like Portland, Oregon, Chicago, Little Rock, Arkansas, Boston, Atlanta, New Orleans. They're all around 60%. Governments need to come up with that money from somewhere. One of the big stories, I believe, in 2014 will be Obamacare. And it's believed that Obamacare created a Medicaid time bomb. And if you believe what they're saying, roughly 1.6 million Americans have enrolled so far for Obamacare. The not-so-good news is that 1.6 million of them actually signed up for Medicaid. If this trend continues, it could bankrupt both federal and state governments. Medicaid is already America's third largest government program, trailing only Social Security and Medicare. As a portion of the federal budget, almost 8 cents out of every dollar that the federal government in the United States spends goes to Medicaid. That's more than $265 billion per year. And you're looking at 48% of spending, Medicare and Medicaid in the United States. They have done nothing to reform the problems, and it's going to get worse as more people sign up under Obamacare and get added to Medicaid. They're saying Medicaid spending could more than double in the next 10 years, topping $554 billion by 2023, and that's just at the federal level, not the state level. You can see the United States has some serious problems. And that's why we're saying hard assets. Now is the time to educate yourself. Get your name on the list for our free weekly newsletter, Worldwide Precious Metals, the company Harold recommends you use when it comes to investing in gold, silver, platinum, palladium. They're there to educate you with their seminars, their newsletters, and as well, give them a call. Find out about investing and starting your own precious metals investment account today. 1-866-623-2002, the website, wwpmc.com. Going to come back and talk about diamonds in 2013. It was an outstanding year. As the World Financial Report on Radio with Harold Siegel and me, Randy Marshall, continues right after this. Welcome back to the World Financial Report on Radio. I'm Randy Marshall. Via the telephone, our financial and diamond expert, Harold Siegel. And this is our final show of 2013, December 27th, 2013. Our time is 9:06. We'll be back in 2014, itching to do more shows for you. Our radio show runs on your favorite radio stations, also archived on Harold's websites, hesradio.com, rarecoloreddiamonds.com. We have a podcast through iTunes. Go to iTunes, type in World Financial Report on Radio. We go anywhere. You can take us via your portable device. Harold does daily market commentary on his websites. You can find it on the podcast site as well. When it comes to investing in gold and silver, platinum, and palladium, there's only one company Harold recommends you use. That is Worldwide Precious Metals. They have an outstanding website. Go to wwpmc.com. Really, it's all there. It's all explanatory, all the ins and outs. You can obviously give them a call as well, 1-866-623-2002. Find out about investing in gold and silver. and find out about their investments and their ideas they have for you in 2014 and the seminars they have planned as well. It was an outstanding 2013 for diamonds. Harold's website, rarecoloreddiamonds.com. Another fantastic year. You can connect with Harold at rarecoloreddiamonds.com or 1-800-432-1022. His auction site, hsfineauctions.com. Our featured diamond of the week is a 1.51 carat cushion cut, fancy, vivid, yellow, internally flawless. This is an absolutely stunning diamond. As I said earlier in the show, it was a great year for Harold personally because he was on Bloomberg Television and Bloomberg Radio. He was interviewed by Deirdre Bolton and Carol Masser. In both occasions, Harold had with him jewelry that belonged to Elizabeth Taylor, and both of the hosts, they put that on. And if you want to talk about ladies being happy, all you have to do is watch those interviews. We do have them for you. And Harold, one of the things that caught everyone's attention at the end of the year, we had that pink diamond that sold for $83 million. Originally, they were talking that it could sell for $60. It sold for $83 million. We also had the orange diamond that sold for $36 million at Christie's, and they thought originally that it might go for around $20 million. So it was an outstanding year for diamonds. The auctions you had at hsfineauctions.com, also Christie's and Sotheby's, diamonds were just an outstanding investment in 2013.
Well, it certainly was. And just going over my client's book and all that, and we hold a large client book of diamonds, on average we went up about 18% last year. So between yellow flawlesses, argyle pinks, deep flawless whites and greens, which are all the areas that we are the heaviest players in the market, our counts went up 18% for 2013, which I'm extremely proud of. So when we talk about diversification, when we talk about keeping money in certain assets that will do well for you no matter what the economy is doing, it's the rare color diamond market that certainly helps us get there. Again, 18% for 2013 in a rough year certainly shows how well those diamonds did. On top of that, the last week of this year, which is normally the slowest, pretty well the slowest year part of the year, we sold 11 vivid pink argyles, which was one of the biggest weeks we've ever had for the most expensive pink diamonds. That again shows where people's mind is, and again, when you buy the very best, you always get the most back for it. Those diamonds are increasing by about 25% a year. So we have a inventory of vivid pink argyles, and as we mostly know, Argyle, which is a mine in Western Australia that produces 95% of the pink diamonds in the world, is getting ready to close. Now, they say it's going to close in 2020, but every indication is at this point that the mine is coming close to its last legs. They're trying to keep it open as long as they can, but what we're starting to see is brown starting to creep into the mine, and is changing these beautiful pink diamonds from fancy pinks or intense pinks or deep pinks or the most beautiful, the vivid pinks, the most expensive by far. It's changing those, and you're not going to see those colors anymore. You're going to start to see brownish pinks, and that brings down the value of the diamond substantially. So the fact is that those of us that own these amazing pinks and purplish pinks and intense pinks and vivid pink argyles, those diamonds are going to skyrocket in price. And again, they can keep the mine open as long as they want to, but if they're not producing those magnificent pink diamonds that the world has gotten used to and wants, well then those particular diamonds will go up more in value than almost any other investment. So we're extremely excited about it. We have a large inventory of argyle pinks. We've invested heaviest in that particular market, and we have diamonds put away for our clients that defy description. Most of our diamonds are not on the website. So again, at this particular point, now what we're starting to do for 2014 is to change the website slightly. Instead of an investing section, we're going to have a learning section. We're going to be able to do seminars for you in the comfort of your own home for investment groups or families that want to get into diamonds and want the education. And we're all about education. So 2014, make sure you sign up for those. Go to the Learning Center. You're going to be able to see our new introduction, the new video that we just shot that turned out phenomenal. I was very, very proud of it. The fact that we've been on Bloomberg twice on television and once on radio is a real big deal, because most people that know Bloomberg understand that you cannot buy your way onto a station like that. Either they want you on or they don't. And again, for 2014, we see many more opportunities with Bloomberg and news agencies like them, because they're interested in the diamond market. They're interested in the hard asset market. And one of the major reasons that they've had us on 3 times is because of the auction market. A diamond is a great investment if it can be sold. So the fact is that we set out to build the secondary market that resells our clients' diamonds. And that will be the most successful part of our business, is the secondary market to resell diamonds. Now, at this particular point, many of our clients are buying. They're not selling. The next 5 to 10 years is when a fortune will be made in the diamond market. Again, if diamonds went up 18% on average this year for 2013, I believe 2014 will be even much better than that. And as the Argyle mine comes closer to the end, the price of these diamonds will just skyrocket. Now, some of you may ask, who's going to buy these diamonds, when the prices reach 8 to 10 times what the prices are today? The same people that are buying them now. Because 5 years ago or 10 years ago, diamonds that we used to buy from Argyle for 5 to 10,000 are now 25, 30, and 40,000. So the fact is that when this mine closes and there's no more of these diamonds, the jewelers specifically will pay absolute fortunes for these diamonds. One of the biggest advantages that we have at this particular point is that we're located in North America, in Canada, and in the United States. The 2 weakest currencies at this particular point are the American and the Canadian dollar. Now, it's not that things are going bad in Canada. It's just that as Canada and the U.S. are major trading partners, they try to keep the currency somewhat in line with each other. So when our buyers from Europe are buying our diamonds, they're buying them at a 50 to 60% discount because of the currency. The British pound is trading at almost 170 to the U.S. dollar right now. That means that they're saving about 60 to 70% by buying our purchases or our diamonds. That's why here in the United States, if you look at Disney as an example, and you look at the price of the Disney resorts, how much it costs to stay there, you would say, who in the world can afford to stay at Disney for a week? Almost everybody is from Europe, because their currency is worth so much more than ours is. So let's say, for example, you buy an Argyle pink diamond for $50,000. And let's say 10 years from now, that diamond is worth $500,000. If somebody from Europe buys that diamond, they're actually paying about $300,000 for a $500,000 diamond. They're saving a fortune just because of their currency. So what we've done is we've actually incorporated our businesses in different parts of the world to give our clients the advantage of trading in other currencies. Because number one, as we're selling diamonds right now, and if we're keeping our currency in Canadian and American dollars, it's all great. But if we want to make money on the currency, I'm going to want to hold an auction in London and auction off some of our diamonds for British pounds. This way our clients can make money on the currency and on the diamonds. So we're all into profit, and we're all into protection, and we're all about insurance, and diamonds give you every aspect of that. They went up 18% on average last year. They never, ever declined in value. They're portable private wealth that nobody knows that you own. And for those of us that are concerned about a government that is socialistic, that has got too much going on, as far as taking part in our lives type of thing, and all the horror stories that have come out of the United States where the government is now insisting on knowing which clients own physical gold and silver because they want to know, because they say they want to collect taxes on it, but people are petrified that they could be confiscated. Well, that can never happen in a diamond because nobody knows that you own it. It's not a listed asset that trades on an exchange that the government could put a value on. It's a very, very important asset. Number one, it's going to make you a lot of money. Number two, it gives you an opportunity to trade in another currency. God forbid if some of these guys are right, these analysts that say that the financial world as we know it is going to crumble, it gives you an asset that can be sold and taken to another currency, and that's not possible in any other asset. So Again, one other thing that's vital is that certain diamonds during times of high inflation have outperformed every other asset. In 1980, when there was $850 gold, 20% interest rates, colored diamonds went up 500% in 1979 and 80. How do you do any better than that? How do you do better than we did this year by picking up 18% on our diamonds? So, again, I'm extremely enthused, very, very excited. This would have been an amazing year for us if gold and silver would have done what it was supposed to do. And again, the only reason it didn't do what it was supposed to do was because it was forced to do that by sources outside of everybody else's control, which is the Federal Reserve and the U.S. government. There's nothing that fundamentally changed in the gold, silver, and hard asset market. The only thing is they wanted the price of gold to come down, and they made it come down, and that's why we lost this year. However, we're not trading the market. We're not selling out of our gold at this point. You know, I've owned gold since it was at $250, and I've owned silver since it was below $4. I rode gold all the way up to 1900, and I'm telling you right now, I did not sell it. I did not sell it, and I have no intention of selling it because I'm not trading gold. And the other thing about gold and silver is the fact that it's a hedge against everything bad that could possibly happen to us. And if there's a potential that that's going to happen, we want to own gold and diamonds because those are the two assets that will protect us against what everybody else is going to get hurt by. So again, everybody has their own opinion. You can view the economy in whichever way you want. You can look at it and say, you know something, you guys don't know what you're talking about. The Dow Jones has gone to, 16,000 and change and hit record prices. Well, that is very true. However, a market that hits record prices with absolutely no growth in the GDP tells me that there is a major problem going forward, and I wouldn't put $1 of my money into a market where I stand a chance of losing that much money. So basically, nothing is really changing. We've added to our diamond positions. My client's diamond book is the highest it's ever been in history. And again, the last week of the year, which is this week, we sold more vivid pink Argyle diamonds than any other week that we've been in business. If that doesn't tell you where smart money is going, China's buying all the gold they can get their hands on. People are paying $50, $60, $80 million for a diamond. People don't put their money into those type of assets if they don't anticipate making a profit. They don't buy a diamond for $35 million and sell it 5 minutes later for $40 million if they're not going to make a profit on it. And that's what we're all about. We're all about protecting our clients and making money in a very, very difficult market. And it's the rare colored diamond market and the gold and silver market that still is my number one choice for what's going to protect us and make us money moving forward. And again, there's nothing that I see in the market, Randy, that is changing that an iota.
RareColorDiamonds.com, featured diamond of the week, a 1.51 carat cushion cut, fancy, vivid, yellow, internally flawless. I was showing someone Harold's website, RareColorDiamonds.com, just the other day, and this woman was just oohing and awing at all the video of the diamonds and just the selection of the pinks and the blues and the yellows, the greens. It's just a stunning website. It's like going to a museum and seeing some of the world's top diamonds all in one spot. Harold was on Bloomberg, and we have those two interviews for you. You can watch them. We'll send it to you. Also, we have an article, A Rising Appetite to Invest in Colored Diamonds, from the New York Times. Diamonds could soon be an investor's best friend as demand rises and supplies fall. Buy that engagement ring now. The coming supply squeeze in diamonds is ahead. Also, we have the stories on the pink diamond that sold for $83 million and the orange diamond that sold for $36 million. And there was one article that I thought was very interesting. It actually was a commentary from Keith Barron. And he said, so the situation remains very dire. And if they don't start to throw massive amounts of QE at the tragedy in Europe from the ECB, things could really get out of control in a hurry. We're talking about major civil unrest, especially in places like Greece. Well, all of this is happening today. We had another all-time high in the stock market in the United States. But even as the stock market continues to roar, we have yet another city in California that's contemplating bankruptcy, just like Detroit did not too long ago. Now, here is where it is really interesting. Luxury goods, meaning portable wealth, are hyperinflating around the world. This situation is really quite astounding. Christie's just had an auction of contemporary and post-World War II art, and they shattered the all-time record for an art auction. The total sales from just one of the auctions was a staggering $691 million. That is a truly amazing number. Christie's crushed the record for a single work of art at an auction as well. The $142.4 million art piece appeared to me to be purchased by a Chinese buyer. At another auction, there was a 14.8 carat diamond that sold for $35 million. As reported, the next day there was a pink diamond sold by Sotheby's, also in Geneva, that sold for $83 million. This is truly remarkable. What is taking place here? I don't think the rest of the world is really appreciating what is happening right now, but portable wealth, and I mean at the very top end, is going ballistic. I need to clarify here that this is unbelievable, the situation, and it appears to be fueled by great many Chinese buyers who are very aggressively exiting the U.S. dollar. And he says they literally want to get out of their holdings in fiat currency altogether and place their wealth into tangibles, particularly portable wealth. Also reported, this is not just the case of fat cats wanting to brag about their latest acquisition. These are people who are really concerned about the massive printing of fiat money, and they are looking to preserve their wealth. People should understand that this is a warning of things to come. The super wealthy aren't buying these hard assets because they're going to go down in price. These people are connected. They know what the end game is going to be. And so they are moving extremely aggressively to preserve their wealth and purchasing power from the coming great inflation. That, according to Keith Barron. And Harold, that's what we're seeing in the hard asset market. And we haven't seen the heavy inflation yet, but you can see the big money, the smart money, is already positioning itself there right now.
Well, you're 100% right, Randy. And again, it is not too late in any way, shape, or form. In fact, the next 5 to 10 years, I think, are going to be the best years we've ever seen in the diamond market. And I believe the same is going to be true for gold and silver. I do believe that we're going to have a different type of bull market in gold and silver, which we'll discuss. It's going to be much more volatile, but none the same. Those of us that own gold and silver at these levels are going to score big by what's going to happen within the next couple of years. Same thing with diamonds. Diamonds are not a short-term investment. You don't buy a diamond today and sell it a year from now. You're not going to make any money. However, get into the diamond market, put a diamond away for safety and for profit, and you're going to find 5 to 10 years from now or longer that you're going to see returns like you've never seen in any other market before. A diamond that I bought in 2003 for $350,000 is worth almost $4 million today. And there are countless stories of that type of returns on diamonds. So the longer you hold them, the more they go up. And in this type of an economy where it's so difficult to make money without taking a gigantic risk, it's good to know that there are certain diamonds that have never, ever declined in value. So, again, I'm very optimistic, Randy. I love the diamonds that we recommended to our clients. Yellow Flawless has increased by about 15%. The larger ones did better than that. The featured diamond this week, the Vivid Yellow, it's one of the rarest yellows. You can't get Vivid Yellows anymore. The prices of those diamonds are going up more than any other yellow diamonds. Then you've got the pinks, the fancy pink, the fancy intense, the fancy deep. They're going up by about 20% a year. But the fancy vivids are doubling in 2 years now. So, we're seeing some huge moves in these markets, and the closer we get to the Argyle line closing, these moves will become bigger and bigger. And I can assure you that if you don't get involved with Argyle at this particular point, you'll never have another opportunity. Once that mine closes, you're never going to be able to get involved in a market like this again, because there's never going to be another mine that produces 95% of any one given diamond.
This week's featured diamond, a 1.51 carat cushion-cut fancy, vivid, yellow, internally flawless. Go to rarecoloreddiamonds.com, take a look at the video. As well, get our free weekly newsletter from Harold. Connect with him at rarecoloreddiamonds.com, 1-800-432-1022, and he'll be happy to send it out to you, and you can see him being interviewed twice on Bloomberg Television and all the articles that we spoke about. But I think the key for me when it comes to diamonds and investing in diamonds is that there's something a little bit more about them. You can't put a stock certificate around your neck. You can, but it would look really stupid. A bond, you can't put a bond around your neck or on your finger. When it comes to diamonds, you can put a diamond on your finger, on your ears, around your neck, on a lapel. Diamonds show. And this is the thing that I remember the lady who owned the Hope Diamond, she said, it's not even so much owning the Hope Diamond, it's the reaction that I get from wearing that diamond when I walk in a room. And I remember when we did the seminar here in Edmonton, and Harold had one of his clients with a beautiful pink argyle diamond in a ring, and she showed it to me, and there was a group of people that had gathered around, and everyone was oohing and awing about this ring, and it was absolutely spectacular. I've never forgot that ring and how beautiful it was. And you can't put a price on something like that when you walk in a room and you have a diamond ring like that on your finger. Sure, it's an investment that will go up over time, maybe an heirloom you can pass on from generation to generation in your family. But the truth of the matter is it gives you a feeling that is priceless. And watch the interviews with Harold, with Carol Masser, and Deirdre Bolton. When those ladies have those Liz Taylor diamonds put around their neck, they are literally in awe and stunned, and privately said to Harold that it was one of the great moments of their broadcast careers because they had the Liz Taylor diamonds around their neck. Harold, we have about 2 minutes left here, but these ladies, they do a lot of interviews every day on Bloomberg. I have Bloomberg on in the background all the time. See Carol Masser and Deirdre Bolton, and it was just stunning to see the looks on their face. That's something you cannot get with any other investment.
That's very, very true. And to be the owner of those pieces is something that in my life I never ever thought would happen. I mean, who would ever think that you could own the iconic pieces of Elizabeth Taylor? I have her last 8 pieces, including her ruby and diamond necklace that's worth over $10 million. When my wife walks into her room and she's wearing Elizabeth Taylor's pieces, I mean, every eye is on her. She's a beautiful woman, but it's hard to not recognize a 95-carat diamond necklace and matching 22-carat earrings. And then, obviously, when the media finds out that it was Liz Taylor's pieces, then it takes on a life of its own. And these pieces at auction can sell for 10 times what the estimated value is. So I've got some of her lesser expensive pieces, her brooches, that the paperwork alone where she signed and wrote down the sketches on these pieces of paper, they're worth way more than what the actual pieces. These pieces of paper are worth $250,000 just because Elizabeth Taylor signed them and sketched these pieces. That's how valuable these diamonds become, and become amongst the best investments you could ever make. So, again, let's go into 2014 and let's right the ship. Let's get into the type of investments that are going to give us the safety that we need, but also increase in value that's going to give us our retirement that we so dearly want, and that you will not get in almost any other type of market.
Harold, it was an outstanding 2013. It was fantastic to do the radio show with you again for another year. And I know here with about 30 seconds left, we want to wish everyone a happy new year, and we look forward to doing shows in 2014.
You bet, Randy. I wish yourself, I certainly wish Mark, the producer of our show, and all of our phenomenal listeners and friends and clients, we wish you all a very, very happy new year. And again, we truly appreciate your loyalty and your patronage. And again, we do these shows for you. We don't charge for our shows or any information or any seminars. We do it for our listeners. And again, we thank you very much. We wish to thank you.